Hello, welcome to another live stream with me, Christian Rauchenwald, on this beautiful, or actually not so beautiful, cloudy Thursday. I hope you all had a great week so far. It's time for another episode of Daily Market Mastery. But before we start and jump into my portfolio and my plan for the rest of the week, here's the usual disclaimer. Everything that I share in this live stream / video is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. Now, with that out of the way, for those of you wondering what's going on here, during this live stream or during my daily market mastery series, I'm pretty much sharing what's going on in my portfolio. For those of you that have no idea what I'm doing, I usually am using Elliott Wave Theory or the Elliott Wave Principle that you can check out by following the link in the description down below. So there's a book that you can either order or you can read it online for free if you use the link below to try to predict market movements and therefore adjust my position. Now, recently, I've focused a lot on trading with options, and they're specifically trading the so-called wheel, which consists of basically selling put options instead of buying stock with limit orders. And on the other hand, if you then have the stock, if you get it assigned to then selling so-called covered calls to basically make the profit through option premiums. Now, with that said, just need click here, click there, and then we can switch to the screen on the right. Yep, so that's how it looks like. Yesterday or 2 days ago in the episode, I talked about GameStop's movement. We currently hold cash secured puts at $20 strike. So if GameStop were to fall below 20, I would have to buy a certain amount of shares. Now, so 2 days ago, the assumption was actually that I thought that this would already be wave 3, 4, 5, and therefore that this would be ABC on the 50-minute chart. It actually looks like an ABC if we zoom out a little bit, which it has to, even if it's wave 4. And that we don't go up from here. That strong movement here misled me a little bit. And then on the evening, I wasn't online anymore. And we originally had actually put options at the $22 strike price, which then this Friday, if we would still be below 22, would have triggered. Now, however, based on the next day, when I looked at the chart, it became obvious that this here looks more like a 1, 2, 3, 4, 5, which makes it a wave A, potentially followed by wave B and followed by wave C down that has those specific, in quotes, not guaranteed, but like likely profit targets. We talked yesterday about that potentially the 21.70 mark or 21.50 mark could already mark the end of the downward momentum simply because we have multiple things. It's on one hand the 50% retracement of this entire 5-wave pattern. On the other hand, it would be the minimum price target for wave C, and last but not least, it's a strong support resistance level if we look back a little bit. However, that didn't hold up. I also pointed out that the next level would be at the $20 mark. Now, I don't see it go below $20, but I could be wrong. The big question is, do we now already have finished 5 waves down here? We see that we actually bounced pretty much nicely on the 61.8 retracement. For those of you not familiar with Elliott Wave Theory, the correctional wave 2 very often turns around at the 38.2 or the 61.8 retracement. Those are the two most likely points. So there's no guarantees. We're only playing with, or we're only trading based on probabilities. Other than that, the 50% retracement also serves as such a line, and in case we would be looking at a so-called leading diagonal, then we would expect wave 2 to turn around at the 78.6 retracement. Obviously, it doesn't always have to be spot on, but right now it looks very nice that we have the turnaround pretty much spot on the 61.8 retracement. So chances are that, or it's more likely than not, in my opinion, that from here we will go up again, which would then mean that the put positions that I have for tomorrow that expire tomorrow will actually expire worthless, which means I will pocket, in this case, $120 premium, and can then sell new put options with an expiration date next Friday. Now, we don't see the premium prices yet because the market is not open, but we will see it in 6 minutes. Obviously, by tomorrow, that price will change a little bit. Now, so much about GameStop, or do we have anything else GameStop related for now? Actually, I don't think so. Yeah. So one important thing to consider is that we also have, sorry guys, we also have the maximum pain this week at 20, or it should still be at 20. And very often, not always, the week will end, or on the expiration date, or it's actually now at 20.50, will end at or around that maximum pain point. I don't know why it happens, but it's yeah, like it just happens regularly enough for a reason. It's like, again, it's a probability that it will end around this, plus minus, let's say, $1 or so. That's the point where basically most of the options that have been bought will be expiring worthless, which means, yeah, like the counterparty to those options, no matter if it's a person or a market maker or whatever, or the options clearing corporation, will pocket the biggest profit, because most of the options are going to be worthless if we end at 20.50. Now, yeah, which stands to reason that bouncing here would in that case make sense. This way, I mean, even if we go a little bit sideways till tomorrow, and then only on Monday we start our move up, I'm still relatively convinced that our movement will look like this, that this we have from the low here, wave 1 in a 5-wave movement, we have an ABC, and we will then get another 5 waves at least up. Even, that's the important part here, so we either have 3 waves here, that's wave 4, and we go up in wave 5, or that's already 5 waves, and that's then would turn that into some kind of wave 1 potentially, and we go down and we go up. So based on Elliott Wave Theory, again, no guarantees, just probabilities. But even if we would be, according to Elliott Wave Theory, even if we would be in a downward trend from here, then that would need to become a corrective pattern, and a corrective pattern, according to Elliott Wave Theory, always subdivides into 5 waves, 3 waves, 5 waves. Yeah, I mean, there are a few rare exceptions, but the point still is a 5-wave movement is not a counter trend move, but a 3-wave movement would be. So even if we would go down from here, we would, according to Elliott Wave Theory, first expect to have another 5-wave move this direction. That should then at least be 61.8% of this movement. Or if it's not a downward movement here overall, then we would expect a 5-wave movement that's stronger, because then that would be wave 1, wave 2, and wave 3, which is usually but not always the strongest movement. To be more precise, the most likely target areas, if this were a wave 3 movement, would be 31.18, 34.34, or if we go through that area in a decently fast move, 46.96 to 51.71. So the extension levels based on this high point. So from the low here, starting point of that 5-wave pattern, to that top here. Yeah. Again, no guarantees, but I'm actually counting on that we will see some action in the near future. Now, we could always move sideways for some time first, but that's pretty much my personal lookout as far as GameStop goes now. And that is also the reason why we are selling the cash secured puts. Originally, that was, as said, a $22 cash secured put based on my mistake that I mentioned earlier in the stream. So that 2 or 3 days ago, I was a little bit or I jumped the gun by thinking that the wave is already done here. That's wave 2, and that's the start of wave 3. So we sold those 22, or bought those 22 put options back yesterday for still a small profit, and instead sold the $20 put options. Yeah, I have to say, I could have made more profit if I would have waited yesterday. So because we bought back the 22 put options around here in that upward movement, and we're therefore able to make a small $35 profit overall still on those. And since I expected it to drop further, I actually should have waited, because obviously at the $20 mark, the premium for those $20 put options would have been much higher. So instead of getting $40 per put option, yeah, it's going to take another minute or so for the quotes to actually show up and the market to open. But instead of getting $40 per put options, we would actually have gotten probably, I don't know, the 3 times that or so. But I'm not trading full time, and I have other things to do than to wait for the price. So I'm going to be happy that we still got the $120. again, the smarter play, yeah, could have set a pending order. So like if I would have set an order that I'm willing to pay, to sell it for more, or that would have worked actually. Should have set a pending order instead of buying for 40. I should have just said, okay, I'm whatever, like for 80 or 100. So if the price then dropped, now we have the quote. So we see yesterday we could have actually potentially gotten, instead of 120 total for those free put options, we could have gotten pretty much like 200 each. So if we waited, or if I waited a couple of hours, but that's it. Now obviously we cannot close those, and I wouldn't want to close those. If we finish the week below 20, which again I do not expect, then we would get 300 shares of GameStop, which is perfectly fine, and would then work with them for next week. If we stay above 20, which is what I expect, then we just pocket the premium, and then actually tomorrow in the evening we close out those options, or actually roll them into next week. That's actually, sorry, I had the wrong price. So yesterday we would have gotten, instead of $40, we might have gotten $120 per option. Yeah, if we would have waited a couple hours. But yeah, as you can see, the premiums for next week are still relatively choosy. So even right now, the $20 put option would pay us around $170 on average, which means if we stay above 20 by Friday, we basically free up our capital requirements. So because we have a commitment that if we are below 20 on Friday, we likely get the shares assigned, meaning we have to buy 300 shares for a total of $6,000. And once we get rid of that option or it expires, we don't have that commitment anymore, and which means for next week we could sell another $20 put option, which would pay us $175 each roughly right now. And depending on how the value of GameStop is tomorrow around close, obviously we might get less or we might get more. And however, if I wait till Monday to get that option, then the expiration will already be closer. So it will be, instead of 7 days, it will only be 5, which means the premium I get will be less. So instead of doing that, we actually definitely want to, tomorrow before the market closes, make our adjustments. Now, there's no live stream when the market closes from my side, but so just so you know. But with that, we really covered GameStop. Now, on the other hand, we have our FFIE, Faraday Future or something options that went yesterday against us, or the stock went against us. So we have a $1 put option that requires us. So this is a relative gamble, to be honest, yeah. But we have a $1 put option that requires us to buy 100 shares at $1, so for $100 total. But we got a $50 premium for that, which means for those 100 shares, our average would already be 0.5. And then we have a 0.5 put option that requires us to buy another 100 shares for $50, which we got $20 premium for. So we got a total or $30 premium. Let's check FFIE 20. So we got a total of $17 premium for those two options. And if FFIE by the end of June is below 0.5, we'll have to buy $150, which means if we consider the $70 premium, we actually will pay $80 for 200 shares, which means our average will be around 40 cents per share, which currently the stock is still slightly above or around, which means right now we'd still be able to make a minor profit, less than the $70 that we got in premium, but still it would not be a losing trade. Either way, the overall play here was like either the stock maintains the price above 1 and I just pocket the $70 premium, and if it drops and we have to buy, I'm okay with having $80 in some in quotes almost penny stock. Either the company recovers and the 200 shares will be worth more in the future, or it doesn't. Now, the other place that I still have open, we have our order yesterday in, what was it called? PWDY triggered, and is at a small plus. I think that we have a wave finished here, A, B, C, and that from here we should go up. Now, right now I said how many shares? The 20,000 shares we got for less than a cent. Yeah, so slightly in plus, but if we consider selling with commission and so on, it would not bring much. We have a trail limit order here, so which means if the price hits here, we will start trailing from our actual buy-in point. So if the stock goes up, we can potentially make a decent profit on the $50 investment that I took here. And if it doesn't, then it's like a $50 risk. So it's like really not that it does a lot of damage. On the other hand, we also have GWAV, which has taken a hit because they announced the reverse stock split, which wasn't perceived very well. Again, we have a small investment here of around $100, a little bit less, I think. And my assumption was we might have ABC done here and go up from here. It looks like it was wrong, so that might be ABC. However, the point is, if we go below that starting point here, then the pattern would become invalid, and then it's pretty much sunk money. Technically, I would have to look into it if I could, because we also have a trail limit order here, because that would be the minimum upwards movement if that in some form is ABC. But technically, I could also say, okay, at 0.04, we'll cut our losses, so that would then be around a $40 loss or so, which would be okay. Or because the position is so small, we just hold and see what happens. And then the last penny stock play that we have right now is this one, CRKN. There I have to admit I entered a little bit too early, but again, I mean, that's like a $100 investment as well, so also not the end of the world. Question is, so obviously we already went below this point here, so question is, will this be in some form ABC? I mean, cannot be because we already went lower here, so it would need to be A, B, C. Similar situation, if we go below 4 cents here, that would actually be the point where the pattern becomes invalid. Although at that point, it's already, I don't know, like an 80% loss on the $100. So then I might as well just hold and see what happens. Interestingly enough, during all our episodes, we browse through posts that I saw on Reddit with people pointing out potential plays. One of them, and we will do that in a second as well, just last but not least, one of them actually was SMFL, where yesterday we looked at it, and I think yesterday during the stream we looked at it, and while the pattern potentially suggested that this might turn into a 1-2 and a upwards movement, I decided not to jump in because there are no options for that, and at $3 per share, like getting 30 shares just doesn't make, I don't know, a lot of sense to me, or didn't make a lot of sense to me. And risking more money than that on a stock with a history like this just is not worth it. However, the people from Reddit were right. As you can see today, it basically went up overnight. So yesterday it already made a decent small upwards movement, and then overnight it just pretty much doubled. Now, if we look here, if that's wave 1 and 2, then wave 3 would actually be here, which means now there would be a wave 4 down, and then there would be a last wave 5 push. Now, potentially that still would mean like, I don't know, 25 to 40% profit potential. Maybe more, yeah, but getting in at this level, it's just, since wave 3 is usually the strongest movement, trying to just trade wave 5 is like too risky. And again, if I just throw $100 at it at those price levels, it doesn't move the needle, and it just, like a missed train. But it's good to see from time to time that the theories that people share on Reddit actually also pay off on occasion. Yeah. Now, with that, actually, let's jump to Reddit and see. I don't think I have that many things saved. So we have one guy. Don't be that guy, in my opinion. I mean, hopefully that's just play money for him. But if you throw around, what's that, 475,000 at an absolute penny stock, that is not profitable whatsoever, and so on, and then you hold to a 90% loss, then so I hope the guy has more money and that was just play money for him, but could have definitely picked a lot of better stocks to play with that money. Like, I mean, it's pretty much a house that he lost here in that stock so far. I don't think that FFIE will recover or shoot up, but maybe I'm wrong. Other than that, there is another potential play, CISS. Let's check that out. I don't think we have that in our list. Nope, we don't. So What's that? Blowout earnings. Okay, they were, yeah. I mean, that's, yeah, not a nice history. If that is true, the low was actually at 2 cents. So definitely already had some reverse splits here because they for sure didn't trade at above 1,000 during the IPO. And probably already missed the move. That could be, I mean, yeah, like it's hard to zoom properly here. Let's try with 4 hours. That might give us a better picture. Just have to, yeah, that might be 1, 2, 3, 4, 5. Well, it's just 1, 2, and that was 3, and we get 4, and then we get 5. Yeah, so I think, yeah, again, everybody that got, yeah, like, I mean, it's not even up that much if you consider that we could have gotten in here at 135. So it's not really such a huge gain. I think risk reward ratio is also not worth this one. So remove the ticker. Go back to saved. So that was that one. Remove. That's other stuff. I think that's actually the only thing I was able to bookmark. What else do we have? So that was this one. Yeah, that was about option strat software. I didn't know. It's kind of like offering a nice visualization. So if, for example, consider the GameStop puts, it's easier than I can for each of those options look at the performance profile and open it and look at it and then change the date here and whatnot. Oh, don't want to print it. Yeah, so change the date here and whatnot. Whereas on option strat, which by the way, that's the free part of it. So I did not sign up for the paid features. You just have like, yeah, I pick the expiration date. I just pick the strike. In that case, for a cash secured put, and I can see the adjustment for the yeah, like profile of the option. So how it would run, yeah, and either as a table or as the graph. Plus on top of that, I can play around with the implied volatility. So how the volatility may or may not change. Right now, the implied volatility for tomorrow expiration is actually 159%. Yeah. So quite a useful tool. So we said 160% to give one an idea. And so that's that, and expiration tomorrow. And then there was somehow, so that's today, how it looks today. So if we would buy the 20 or sell the $20 put today, at which strike prices we would start to, in quotes, lose money, and where we would make profit. Right now, the maximum profit, it says, would be 45.50. I'm not sure if that's true. Yeah, I mean, yeah, a little bit more. So right now it would be $51, yeah, minus the commission, so like $50. But close enough. Don't know what's the data source for them. It says also delayed, so data is delayed, upgrade for access. Okay, so that might explain it. But it's quite a cool tool to play around and see different options. So also in terms of, if, for example, I always consider selling the weekly options because we get more premium and then we can close it in a week. But on the other hand, it also means if the price moves against us, obviously we have the commitment to buy the shares, which I'm okay with at $20 per share. However, if we move out, then we can see how the profit loss changes. So if we go for the June 21st, implied volatility right now 183%. So if it stays the same, yeah, then we would see, okay, that throughout time, so how time plays in our favor. If we sell the $20 put, that at the end of the day, because the premium is higher, so it says $320, although that's obviously then for 22 days, whereas the other one is in that case for a week or for 2 days. Yeah, we actually get a little bit more. So we would see that at the end, even if the stock drops to $17, we still would look at a very small profit because we would get more than $300 in premium, which means that if we would have to buy the 100 shares for $2,000 and we consider the premium, we actually only would have paid 1,600 something for the shares. So meaning that even if it falls by 20%, we'd still look at a small profit if we then instantly sell the shares, or we could sell then cash covered calls at the $18 strike price to earn premium from the calls as well. Whereas the earlier in the expiration, or the thing with the time is actually that if the stock moves up a little bit, so if the total premium would be 320, then half of it would be 160. So we would see, for example, that even if by the 10th, Monday the 10th, even if we would only go up to 2250, we could already buy the option back and basically lock in around 50% of the maximum profit in less than 50% of the time. Or if we reach, I don't know, like let's say 26 on Monday, then we could also lock in more than 50% of the profit already and then sell another option to actually still make more money in the long run. So there is actually an argument that can be made for selling long-term put options. If we look, for example, here, if we go the extreme scenario and say we sell a long-term put for January 26, yeah, so saying by 26 we would be willing to buy, the actual premium would actually be right now $920 that we would get for that option, which obviously is way more than we could get in just a week. But obviously, if we would have to hold for that for those 596 days, the return would be lower. However, we can also see that even if we just go to, for example, let's say by June 28, or there's like one monthly date now, yeah. So even if we, would have to go up substantially to secure the profits early. On the other hand, so like if we sell the shorter time option, which we set for the 21st, if we reach let's say Monday, if we reach 26th roughly, we already secure half of the profit of $177 and could sell another option. Whereas if we sell that long-term put option, if we reach 26, we can only realize like, I don't know, like a 9th or an 8th of the total premium. I mean, by Monday, yeah, we don't have Monday here available. So, and then could sell another option. So, like still something to figure out, but we can also see that the overall loss is much less, because if we obviously get $1,000 almost, or in that case, as we can see, it would be right now $920 for the commitment to buy 100 shares at $20 in 26. It means that even if the stock is in almost 2 years from now below $20, we still got the $920 premium. So our average buy-in would actually be 1080 instead of 20. And that wouldn't be too bad. You can also see that basically even at a 32% loss, we'd still look at a net profit. Although that would then mean for having $2,000 in quotes locked in or as security for that position, we would have made in 2 years $348. So it's less than 10% per year. But yeah, we can see that only if we fall 48% at least, we would start to be at a loss after 2 years. Yeah. And if the stock moves sideways or upwards or so, it would be profitable. Yeah. But I think it's about risk and reward. So again, I'm still just diving into options trading and so on. So on one hand, selling the short-term options means we can sell this one, and either we end up with the shares and have them to sell covered calls, or we lock in the profit, and then we can sell the one for next Friday. And again, same thing, either collect the premium and the premium sums up over time, or end up with the shares and sell covered calls. And then we can sell for next week and next week and next week and so on. And it would always be roughly, I mean, as long as the volatility stays like this and so on, it would always be relatively high premium compared to the capital we have to risk or commit. Because if we consider 2,000 collateral, but on the other hand, we get almost $200 premium. That means we almost get 10% return on the capital we put at risk. And that's for a week. Yeah. So, and obviously if the stock drops, we have a bunch of shares and then we can sell covered calls, but it's quite good in my opinion. Yeah. And whereas compared to if we sell the long dated put option, and even if it's not that long, but if we say, okay, let's go for the one in, I don't know, July, then yes, we get more premium now. So if we sell 3 options like those, it would be $1,200 that we get now, but that's $1,200. So return for a $6,000 capital commitment over a period of 2 months or a little bit more than 2 months. Whereas again, the weekly options pays almost 10%, but within a week. So yeah, like I'm sure there are upsides to the longer dated put options. They probably offer you more flexibility in terms of rolling them out or so. Yeah. So when the price moves against you, to still be in a profitable area, as we can see here, depending on the time. So if we say but until July, then throughout June, even if we fall to $18, we could still buy them back potentially with a small profit. If we don't want to get assigned, and towards the end, actually, so everything above 15.73 would still mean we can close it out at the end for a small net profit. And that obviously is the benefit. But on the other hand, can we switch that? Build, how about call? On the other hand, if we get shares assigned, we can also asset and sell covered calls. So we could then, if we get them assigned at 20, we could sell the 20.5 covered call. And then again, if depending on the date we pick, asset get some extra premium. In that case, again, 10% of our investment. Of course, if the GameStop shoots up, we only make a minor profit. Because our shares are then sold at 20.5, even if the stock trades at 40. But we also pocket the premium, and then we, in quotes, got rid of the shares if we want to do so, and can then sell cash secured puts again. On the other hand, we can also, if we get the shares assigned, we can also sell higher strike prices. So we could say, okay, I'm then going to sell I don't know, $30 covered call. We can see there's also a small credit involved, so it still would bring around $93 per 100 shares that we own, so which would be 5% of the capital that we had to use to buy 100 shares at 20, which reduces or improves our average share price, blah, blah, blah. But it also means if GameStop doesn't shoot up, we just pocket the premium and do the same for next week. If it shoots up, we pocket the premium, our shares get sold at 30, so we pocket a 50% profit on the shares as well, and then again can sell cash secured puts. Yeah, I think the maximum thing would be to go with a long dated covered call. I mean, as we can see, then even the 30 strike price would bring a $1,000 net credit. But the problem is then that basically we would have to hold the shares till then, and if they rally up, we still would only pocket the 50%. If they don't rally up, we still hold the shares and yeah, only get the premium. But yeah, anyway, yeah, like, so that's how it looks right now. So if we go again through the portfolio, so we have the FFIE options for which I don't have the current pending orders for those. They were to end of the day. So I basically got $20 for that put, and I could actually buy it back for 20 right now, which means it would be a small loss. Don't want to do that. And I paid, or I got $50 for that, and I could also buy it back. So, but since we only have a maximum $80 exposure, considering the premiums, if the stock till June stays under $1, I don't see a reason to close those right now. However, for our GameStop puts, we actually have orders on the market to buy them back if we can buy them back for 1/3 of what we got. So basically lock in 2/3 of the profits. Yeah. And other than that, there's actually not much right now going on. So our capital commitment or overall, let's check that real quick, is basically, so we have the 2 GameStop 20 puts for June. We have the 10 put for June, and we have the 1 and the 0.50 puts for FFIE. And then we have the 20 put for GameStop for tomorrow. So our total committed capital would be $7,150, which means we actually, sorry, that's not 120 put, sorry. So 71.5 plus 20 plus 20. So actually $11,150 is our total capital commitment. So we actually right now don't have a lot of excess liquidity, although it says we have 3,300 in excess liquidity because yeah, not all our funds are required to hold those positions. But if we were to sell additional put options right now and market moves against us, then it would actually mean that we risk getting some positions liquidated to ensure margin compliance. So right now, the only thing to do is basically wait till tomorrow, see if GameStop finishes above or below 20 to either just pocket the premium and then sell another option for, as said, June 7th, or to get the 300 shares assigned next week and then sell the covered calls and profit that way. Yeah, that's pretty much it. So yeah, I guess we're gonna leave it at that for today. And then see you all again tomorrow. It's going to be curious to see how GameStop moves today and tomorrow. But again, like considering that maximum pain is at $20.50 and we're right now trading at $20.45. Interestingly enough, a quick switch. So while we were talking, or while I was talking, last thing for today's stream, actually GameStop had that broke through the 61 point. No, that already happened earlier. Yeah, so we already went before. Broke through the 61.8 retracement here at 2070 and actually briefly touched our ultimate profit target where wave A and wave C would be the same in length. And let's see if we turn around from here. I said maximum pain is at 20.50, so it stands to reason that we'll finish anywhere around that. Even if we finish slightly below 20 tomorrow, chances are that I still don't get the shares assigned because it really depends then if how we move in the aftermarket, because there are like 90 minutes after the market closes for the person that bought the put option to decide if they want to exercise it. And it may not be profitable for them to do so if we are not far enough below 20. But yeah, we'll see if this will be the first time since I started trading the options wheel that I will actually get shares assigned or not. And yeah, with that, I'm gonna leave you to it in quotes. Thanks for tuning in. I hope you learned something, and see you then all likely tomorrow with another live stream. So don't forget, subscribe, enable notifications so you don't miss that, and then see you all